All right, guys, big week to recap. We have a lot of data coming out this week. The NASDAQ has been down 2 or 3 weeks in a row, so obviously a lot of volatility. It is Monday morning, and even right now, Tesla is the biggest loser on the market right at the market open for the S&P. The reason being, dropping prices again. So if you'd like to engage with me, one thing I ask you to do, follow me on Twitter. I'm very active on there. I talk about a lot of investing and economic ideas. Please follow me there. It's a great place to go. And then follow Everything Money channel at eMoney YouTube. Same thing. So guys, go on there, check us out, and have a conversation. Okay, so let's first talk about what news is coming out this week. Today, nothing much. Tomorrow, U.S. retail sales. Consumption is 70% of GDP. So this is really going to be an important metric to look at for how the economy is going. Remember, the Fed is worried about inflation. Low unemployment increases inflation. They want to fight that. They want to get the unemployment rate up, which causes less consumer spending. They don't want to see too much consumer spending because for them, it'll say things are still going hot and they need to pare things back by increasing interest rates even further. Wednesday, housing starts, as well as the July minutes from the FOMC meeting back in July. Now, housing starts are important because a big inflationary factor has been the cost of housing lately. And that's a concern for the Fed. You saw interest rates go from 2.6% 2 years ago on a 30-year fix to now over 7%. So like most people, we'd have thought, oh my gosh, that's going to do terrible things for the market, such a quick increase in interest rates. Spoiler alert, housing was still really high. And the reason being is inventory. 10 or 12 years ago, there were 4 million houses for sale in the US. Today, there's a little over 1 million. That's a 75% decrease. So don't forget, I talk about this all the time, especially with housing, supply and demand. If demand is big, but supply is huge, like in the mid-2000s, you're going to have a problem. But right now, we have a lack of supply. So even with decreased demand, you still have a lack of supply. And I think that lack of supply will probably last quite a while. Why? Well, something like 90 or 95% of people have an interest rate lower than where it is today. Maybe it's even higher than that. So if you're going to move, you're only going to move because you have to move, whether your family's growing or you're moving. That's the only reason to get rid of that rate. How many of my friends have said, you know what? I'd love to move, but I have 2.8, I have 3%. Why should I move? But you better believe that if all of a sudden they had 5 more kids or even 2 more kids, they might say, hey, we have to move. And as their incomes go up, they'll be able to absorb that higher interest rate. Remember, the interest rate we're at right now isn't some crazy high interest rate based on history. It's just a lot compared to what we were recently experienced. So eventually people get used to these higher interest rates and they'll be fine with that. Finally, on Thursday, the Philadelphia Manufacturing Survey is going to come out. Obviously, manufacturing is a component of the U.S. economy. We want to see how it's going there. So watch us throughout the week. We're going to have a lot of videos releasing things, talking about things. But let's go to our very famous stock market to GDP indicator. Now, guys, the stock market to GDP indicator is what Warren Buffett claims to be the single most reliable metric. Now, there's a lot of haters out there going to say, Paul, it doesn't really matter anymore because, guys, it's still the same thing. And for those of you who doubt this indicator, I'm also going to go over the 10-year cyclically adjusted PE ratio. What that does is it takes the last 10 years of earnings on the S&P, brings it to today with inflation, and looks at the PE of the market based on that. Okay? It might surprise you where that is. Now, when I hear a lot of people doubting this indicator, both of these indicators, I think to myself, okay, they just don't want to face reality. We are in an overpriced market. We absolutely are. Every reliable metric in history, says we're in an overpriced market. The only things I hear are people saying, well, the forward PE isn't as bad as you portray the stock market to GDP indicator. Okay. You're telling me that people are very rosy about the future and that should be shocking to you? The bottom line is we are in an overpriced market. How overpriced? Well, let's take a look. This is my sheet going back to 1929. 1929. Historically, the average for the stock market to GDP ratio on this is 0.92. We're at 1.667. That is 78.6% overvalued. Now, the end of last year, we were at 57.4 because we saw a big drop in stocks last year, but now we've seen a big surge. But guess what? The GDP going up so much helps this indicator stay lower. Look at this. This is my fair value based on what the S&P should be based on the historical average of this indicator. Just back in 2020, we were at 2,000 for fair value. Now we're at 2,500. That's a 25% increase in fair value in 3 years. Why? Well, look at stocks. Look at GDP, I mean. We went from 21 trillion to $27 trillion in GDP. Hey guys, there's one of the benefits of inflation. It really drives up GDP, which is our nation's income, okay? Now, I will get to what that means shortly, but let's look at the 10-year cyclically adjusted PE ratio. We are currently at 30.79. The average is 17, so we're 80.7% overvalued. It's actually higher when just looking at earnings. And guess what? These are with very high profit margins. The current profit margin, corporate profit margin relative to GDP is over 10%. Historically, it's like 7%. So we're still at very high profit margin levels. And those profit margins will go like this. And guess what? They're highest during economic expansions and they're lowest during recessions, right? That makes sense. So what I'm trying to say here is not when there's going to be a crash or if there's going to be a crash, just saying, guys, you should expect that if you invest your money today in the stock market, which I still think you should do if your plan is dollar cost averaging every single month in a low cost ETF. But you should expect a lot of volatility. You should expect not to make very good money on your money invested today. But the point is you never know what's going to happen. Look at me. I've been wrong for the last few years on where the stock market should go, right? Like I was sitting here back in 2018 saying stocks should be worth, and I remember saying 1,800 in the S&P. And look, right here, and guess what? It just kept, yes, we had COVID. We had a COVID crash. It took us down to 2190 on the S&P. And I thought, great, this is the start of it. We're going to get to good levels. And then, boop, skyrocket. That's what I did. I fought the Fed, and it didn't work. And I've learned my lesson from that. So learn your lesson from me and my mistakes. But do not deny. Do not sit there and not accept the fact that we are in an overpriced market. But over long periods of time, this is what's going to happen to stocks. The value is going to go up like this, but the price is going to be like this. And you never know when we're going to be here or here. So the point is, invest all along the way, and guess what happens? You'll average this and beat 98% of your friends and family in investing just by investing in low-cost ETFs month in and month out. Now, obviously, if you want to invest in individual stocks, we're the channel for you. We're here to teach a process. And that process can be applied to any sort of investment, but especially for our software, real estate and stocks. And in the stocks, you can go pick individual stocks. But I don't recommend you do that with the majority of your money until you're comfortable with it. I didn't even do it until I felt comfortable with it. I was all ETFs back in the great financial crisis. And as time went on, I decreased that to individual stocks. And now my goal is to be 100% individual stocks. Right now, I'm about 10% stocks and 90% treasuries. Okay, because I can afford, because of all my business upstairs and all my cash flow and my outlook, to be wrong for a while, which I have been in terms of where stocks are going. But I'm okay with that. I'm sitting here saying that in the short run, stocks are a voting machine, and in the long run, they're a weighing machine. What does that mean? It means in the short run, what's popular is going to go up, what's unpopular is going to go down. But in the long run, what's fundamentally behind every business is going to dictate its value. Okay? If you pay a reasonable price today for a company and fundamentally the company gets better, you will probably do as well as the company fundamentals go, right? And that's what's important. And there's a separation between company and stock. That's what's important to us. We want to sit there and see where that mispricing is happening. Like I said, look at a company like Tesla. Tesla today, let's see how it is right now. Pulling up in our software, down 2.85%. I think Tesla is massively overvalued. But I think Tesla did a great job changing the car industry. And I think they'll be one of the players, the big players in cars for the foreseeable future. But it doesn't mean that I'm going to buy the company just for that reason. Apple's a wonderful company. I think it's overpriced today. But there are 12 companies that I currently own, and you should watch our channel and subscribe because every so often we do videos on the companies that I own. But remember, you should not own companies just because me or some other person on YouTube has it. We're here to teach you a process on how to look at investments. That's what's key here. We want you to be able to, if all of a sudden YouTube went away tomorrow and you can never talk to me again, you say, doesn't matter. I can apply the same process to investing. That's what's important. It gives you the power to control your financial future. You should not have to rely on other people for that power. That is what's key here. So guys, big week coming up. A lot of important things. If you don't already subscribe to the channel, you need to, because we're here to teach you a long-term process and way of thinking. Thank you very much for your time.